Inside India, I'm Sri Jegarajah. Here are your headlines. The inaugural ASEAN GCC China summit gets underway today. We will look at where India stands in the multilateral trade picture. And the CFO of India's top steelmaker, JSW Steel, will be on the programme. Lots to talk to him about, including tariffs, earnings and M&A. India's market regulator may have removed one more roadblock that could put the NSE a step closer to its long-awaited IPO. We'll bring you the details coming up. Let's take a look at the broader Asian markets first. Broadly negative with a few exceptions. Australia and New Zealand and the Straits Times on our front doorstep are just hanging on in there, just in the money. Elsewhere, as I said, it's a rather bleak picture. ASEAN GCC China Summit, in the meantime, is underway in Malaysia. Let's head out to the capital, Kuala Lumpur, where JP Yong is leading our coverage on the ground. JP.
Absolutely, Sri. And again, a lot of important discussions happening here at the ASEAN GCC China Summit. It's the first trilateral meeting that's being held by these three important economic blocs in Asia. And again, combined, they have about a combined GDP cumulatively of about $24 billion as of 2023 estimates by the World Bank. And again, the talks have become more important, it seems, because of the current backdrop with perhaps a breakdown, at least in terms of free trade and also multilateralism. This is something that Li Qiang, of the Premier of China, has echoed in his speeches, and also something that was also seconded, at least, by comments from such leaders like Prime Minister Anwar Ibrahim of Malaysia and also Prabowo Subianto of Indonesia also. So again, working towards multilateralism, making sure they can build new trade ties actually is going to be very important. Now, what's also interesting, though, is that while they try to advance and at least accelerate the free trade area that they've actually built with China, that is ASEAN and China, and also trying to build a free trade area with the Gulf region, there's also been talk on the sidelines about the free trade agreement that they want to foster with India. In fact, the Minister of Trade here in Malaysia, Tengku Zafar Aziz, at the end of the ASEAN Economic Council meeting, actually did indicate that there is an indication that perhaps that they're concerned about the lack of progress in terms of advancing these free trade talks. This is something that was actually broached by Thailand after Indian Prime Minister Narendra Modi visited just a few months ago, actually, the idea of broaching and perhaps elevating any free trade agreements that they have actually with Southeast Asia. And this is something that's the back of everyone's mind, because while they are focused on the GCC and China here, keep in mind that ASEAN's goal now is to try to broaden their economic linkages with various major economic blocs. And you cannot ignore India in the context of Asia as well. However, there are it seems to be a couple more wrinkles that need to be ironed, and perhaps a bit more haste if indeed they want to achieve a free trade agreement that will loosen and free up possible economic ties between the subcontinent and that of Southeast Asia, Sri.
Absolutely, JP, and let's get some further detail on those wrinkles that you referred to, because it's very clear that trade relations are not entirely frictionless, especially when it comes to the steel sector. Intense competition there. Countries like Vietnam could be competing with India to emerge as the top dog, the top steel exporter. What can you tell us about how all sides and all parties are trying to square that circle?
No, I think this also feeds into the broader concern, actually, about possible oversupply and possible dumping concerns from certain major producers and certain major manufacturing bases like China and Vietnam. We do know that Vietnam has looked at Chinese steel actually looked at the possibility of dumping of Chinese steel into Vietnam. But Vietnam is also a major steel maker. In fact, they are one of the biggest exporters of steel to the United States and also export steel to India. And this has also caught the ire, at least, or the attention of steel makers who are based in India, who have also looked at possible tariffs to perhaps deter imports of steel from places like China and Vietnam. To add even more wrinkles to that, it's not only Vietnamese-made steel that they're actually concerned about. It's also concerns that China might be rerouting steel products into India, into Vietnam, for export to India, which then comes at the detriment of some of the domestic steel makers out there. Now, we did speak to Kyu Jin of the London School of Economics earlier on today, where she does think that oversupply concerns from China might be a bit overblown at the moment, because in her view, a lot of the manufacturing that's leaving China is actually moving to some areas like Vietnam, like Southeast Asia, like India, because China wants to move the value sector. And if there is any oversupply right now, the key for China is to try and absorb that through stimulating and rejuvenating the domestic consumer there to try and absorb that oversupply. Again, these are all easier said than done, and definitely just shows you that while they're trying to build these free trade agreements and liberalize trade more along these new linkages, actually, you'll have to watch out for some of these wrinkles, such as oversupply, such as unwanted competition. Some might even say unfair competition, but it's going to be very difficult to prove that at the moment. And that's something that everyone in the region will have to at least work out if they want to establish more free trade across this region, from China, Southeast Asia, the Gulf region, and India included, Sri.
Overcapacity and second round effects, very, very challenging. JP, excellent. Thank you very much indeed for that. Let's stay with the sector and some reprieve for JSW Steel. India's top court halted liquidation proceedings of Bhushan Power, a company that JSW Steel has been trying to acquire. This comes weeks after the Supreme Court rejected the $2.3 billion acquisition and ordered liquidation of Bhushan Power. On the earnings front, JSW Steel reported a profit surge of 16% on year in Q4, but missed analysts' expectations. Revenue from operations dropped 3%. Domestic steel mills in India during this period saw job cuts and scaling back of production due to cheaper imports. Country has now imposed a temporary safeguard import duty of 12% on some products. Let's address this and these other challenges and opportunities in the steel sector with Swayam Saurabh, CFO at JSW Steel. Swayam, thank you very much indeed for joining me on Inside India. Let's start with the overall impact, as you see it, on JSW of US tariffs on steel and aluminium, and how is JSW adjusting to these trade restrictions?
Good morning. Thanks for inviting me. India, JSW Steel do not have any direct exposure to US. We do not export, India as a country do not export a lot directly into US. US has always been in a protective regime. So I don't see a very large impact. What could be a risk is if some steel flows which were going into US, if they have to readjust, India could be a market because it's been on growth paths, growing in double digit. That's the only risk we have to watch out, but there is no direct impact which I see today.
I understand, Swayam. Thank you for that. Then in March, India announced 12% tariffs on steel imports targeting China and Vietnam. We were talking about this, my colleague and I. How have these import taxes helped, in a way, JSW? And how are you going to reconcile that with entering or expanding into the Vietnam market? Because clearly there must be a market opportunity there. And how do we approach this tariff dilemma then?
Well, the safeguard duties which are implemented have helped. We have seen prices improving towards March, also in April, which is something one should expect going into quarter 1. We, JSW Steel, remain primarily a domestic producer. The capacity which we are creating is for India. The demand growth has been phenomenal, double digit last 4 years in a row. So our focus primarily is India. We are not looking to, evaluate markets outside India. We do export, but that percentage also has come down over the last few quarters. Our focus is primarily India. We are building capacity for India, and we think there is going to be a market to absorb it.
Understood, Swayam. Thank you for that. And how will the conclusion of landmark trade deals with the United States, with the EU, UK, India is already in the bag. How is that going to help in terms of trade flows and ultimately what's going to be the material outcome for JSW?
I think two. One is trade flow normalizing would ensure that excess supply in global markets has less risk of, let's say, reaching India, so a normal operating environment. The second is indeed if things starts to normalize, something we see already. This would create opportunities for Indian steelmakers, JSW Steel, to also access markets, for example, like Europe, which is traditionally our largest export market.
Let's turn to India, and Swayam, you believe that the core market is going to continue to be the primary focus area for JSW. We will be getting quarterly GDP at the end of the week. If demand is robust, phenomenal as you describe it, is it consistent with a headline growth rate of 6.5%?
It's very much so. If you see India as a country is in a phase called build phase, where country is, aiming to become a developed country by 2047. And any country going through this phase, you typically have a multiplication factor of 1.5 to 2 when it comes to steel consumption vis-a-vis GDP, which is what we see going into this year, FY26. There are a lot of positive headwinds. We see government capex going up to 11.2 trillion rupee. We see private capex picking up with interest rates coming down, credit availability in India. We also see a good monsoon, which will help with rural demand. So all of these positives makes us very confident about the fact that we'll be able to hold this growth rate and demand.
Can we bring in corporate activity? And Swayam, if we can just take a step back, and can we talk about the strategic and the commercial logic driving this planned acquisition of Bhushan Power and Steel? And can you walk us through and help us understand why this takeover has been rejected?
Look, this matter is sub judice, and the decision has come from the highest judiciary body of India, Supreme Court. So I'm going to be restricting my comment. What I would want to tell you here is, we have implemented the resolution plan completely in compliance with law. We have brought this asset from a 2.7 million ton struggling steel mill to 4.5 million ton healthy company to the state at which it is today. We are in touch with our legal teams, and we are very confident that the remedies we have will help push our case, and we're going to proceed with that. But we remain very confident that it should improve from here as far as BPSL is concerned.
I see. But what is the fundamental value that you see that you can extract from Bhushan Power and Steel if and when it becomes ultimately part of the JSW broader business?
It has been part of JSW broader business for last 4 years now. The Supreme Court judgment rejects the original resolution plan. We are taking legal remedies with a goal to restore to where it was prior to the judgment, so that it remains an integral part of JSW Steel.
I understand. And how has, getting back to the domestic picture, how has JSW benefited from the government's infrastructure program and higher government capex spending? Is there more to come? And how much capex is JSW Steel itself allocating for future expansion?
So we are very positive about the demand which is expected this year, FY26. And a large part of this demand growth comes from government capex itself, primarily driven by central capex. So last year, the government total spending was about under $10 trillion, 10 trillion rupee, which is expected to go to 11.2, and that would push demand up. There are other factors as well, which gives us, confidence that demand would hold going into this year. This also means we stay on track from our capex plan perspective, where we have announced we want to get to a 30 million ton capacity company by FY31. And part of that annual capex spent would be about 20,000 crore, about $2.5 billion of capex we expect to spend this year.
Any thoughts about the pricing environment over the next 6 to 12 months for your main product portfolio? And how are you managing the cost base, Swayam? How are you managing forex fluctuations? And ultimately, what does the outlook hold for consolidated margins moving forward?
So overall, the margin this year, starting with Q1 of FY26, we should expect to see an uptick in margin. Prices pretty much bottomed out in last 2 quarters, and we saw prices improving from end of February, early March, and then April. Apart from price, what you'll also see going into next year is the newly commissioned capacity of JBML, which was ramping up last year, would operate on full stream. That would also help bring costs down. We also expect other efficiencies as well as price-driven benefits, for example, coking coal, where we saw almost $50 reduction year over year. In Q4, coking coal prices came down by about $15. And we have guided market that in Q1, the prices should further improve by $10 to $15. A combination of this should translate into a better margin as we go into this year.
So it's interesting that you mentioned coking coal, and just give us a sense of where you are in terms of the transition and onboarding sustainable steel solutions and processes into the manufacturing line. And how is ultimately JSW managing this switch from coal-dependent blast furnaces to electric arc furnaces, EAF?
No, I'm glad that you asked. So we are the largest steel producer, and we believe that this size also comes with responsibility. In 2021, we raised our first sustainability-linked bonds. It was first in steel, any steel company globally, where we have committed that we will go from 2.4 tons of carbon dioxide per ton of crude steel to 1.95 by FY30. Last year, we also announced that we will become carbon neutral by 2050. Now, these two are, quite aggressive, ambitious goal, and there are clear plans which will help us get there. So if I can use few examples, this quarter, we will have 1 gigawatt of renewable energy commissioned. Another 1.4 gigawatt of renewable energy is under commissioning. So by next 12 to 15 months, we will have 2.5 gigawatt of renewable powered supply, which is available to us. We have announced, potentially a low carbon emission steel making facility near Mumbai. It's a place called Salao. And, it'll essentially be electric arc furnace, which is, DRI based electric arc furnace, which will be, powered by renewable power. And it will be natural gas fired. This would take the total emission from 2.4 very significantly down to about 0.7.
Yes.
These are the building blocks. And, we are constantly working on. Our first goal is to get to 1.95. If I can share here, our internal goals are even more aggressive. And we want to become carbon neutral by 2050.
Understood. So what are the cost implications then? If you're shifting away from abundant, cheaper coking coal, then what are the cost implications of doing so? And you mentioned the green bonds. How are you funding and financing that?
So cost implications, the steps which we have identified, many of them are actually cost accretive. It actually helps me bring my costs down. If I go back to my example of renewable power, the cost of drawing power from grid today, which would in backend coal-fired, versus cost of renewable, I have a very clear positive cost arbitrage. So that supports any investment we make there. A number of other actions we are taking. For example, the newer blast furnaces, although they are coal-fired, but they are far, far more efficient when it comes to fuel rate. So that also helps us bring emission down per ton of crude steel. In future, we also plan to, move more towards electric arc furnaces and, greener steel route other than Salau, but that would need a lot of infrastructure to come in place. For example, in India today, scrap collection is not as organized as some of the developed countries you see. So
Yes.
when that starts to become available, we will also switch there. But so far, the actions we have identified, they are positive from a cost perspective.
Understood. Swam, final question, and it's back to international, which you made very clear is increasingly a smaller part of the portfolio, but they have not been performing as well as they should, especially Italy, which reported a fourth quarter loss. Just how committed is JSW to international? When will those underperforming parts of the international business turn around? And do you have any plans to divest loss-making divisions?
So we have investment in US, and US has been struggling, from a financial performance perspective. But the positive is in last 4 months, because of MAGA and trade policies which US announced, the steel prices in US have gone up by almost $300 to $400. That actually makes US operations at this stage very attractive for us. Italy is, essentially a rail mill which we have, which primarily supplies to Italian rail and other European rail companies. Italy has been profitable. Italy was profitable on a full year basis last year as well. But of course, the margin percentage came down last year versus prior years. We are also confident that going into FY26 with RFI, which is Italian rail order, large order coming in, we will go back to the normal level of performance. So Italy has been profitable. Italy will remain profitable. We should expect to see a turnaround in US.
We look forward to that. Swayam, we'll leave it there, sir. Thank you very much indeed for joining me on Inside India with your insights. Swayam Saurabh there
Thank you,
from
Sri.
JSW Steel. Thank you. Let's take a look at the Indian markets and what to expect, because they will be joining us soon. Here's what Gift Nifty futures are indicating for the open, and it looks like we're going to hold above 25,000. Where we left off yesterday was just a wee bit above that threshold for the Nifty 50, so let's call it little changed at the get-go for benchmark Nifty. Dollar rupee exchange rate at 85.0990. Now, the Indian markets regulator SEBI giving more authority to exchanges and depositories on appointing management. This will lead to market institutions having positions like Chief Risk Technology, Information and Compliance Officers. At present, they are only needed to approve managing director positions. Analysts say this could pave the way for an IPO from the National Stock Exchange of India. SEBI had earlier flagged lack of key management positions as a hurdle in NSE's IPO approval. Meantime, Bloomberg is reporting that the exchange, NSE, has offered around $118 million to settle disputes with SEBI. A decision on the offer is expected soon. We spoke to the chairman of SEBI last week, and here's what he told us on resolving the issues related to the NSE IPO.
I think all of the issues will be resolved. I think that much I can say, both on the governance, litigation, technology, all of it. It's possible to resolve. I think they're quite amenable to solutions.
Coming up, we'll bring you news and updates from around the world. Stay with us. We're back in 2. Welcome back. You're watching Inside India. Some of the stories we're keeping tabs on outside of India. Liverpool fans' celebratory mood took a sharp turn when a car ploughed into their trophy parade celebrating their Premier League title win. No deaths have been reported. Nearly 50 people were injured, though, and half were sent to the hospital. Police have ruled out terrorism and have since arrested a 53-year-old British man. UK Prime Minister Keir Starmer called the incident appalling and said he'd continue to provide support to emergency services and authorities in dealing with this incident. France and Vietnam have signed nearly €9 billion worth of deals during French President Emmanuel Macron's visit to Hanoi, including a major purchase of 20 Airbus planes by Vietjet. The agreements also cover satellites, defence, energy and transport. Macron's visit comes as Vietnam faces tariff pressure and seeks to balance ties with major powers. US President Donald Trump is considering redirecting $3 billion in federal research grants awarded to Harvard to trade schools. This move comes amid his broader efforts to restrict foreign student enrollment. International students make up about a third of Harvard's current school year. The university says the cuts are unconstitutional and have sued the federal government to protect funding and international students amid these tensions. Now, shared working spaces in India are turning a new leaf post-pandemic. We will speak to one of the biggest players in the market, that's Office Space Solutions, after this short break. Welcome back to Inside India. We are counting down to the market open in the benchmark, which is about 15 minutes away. Let's give you nifty futures for the setup. We're looking at 25,000 holding, so no great shakes at the open, actually. Dollar rupee exchange rate at 85.1310. Now, the earnings parade continues in India. Shared workspace provider Office is the latest to report Q4 numbers, operating revenue surging 46% in the fourth quarter and a similar quantum for the fiscal year 2025. Net profits rising almost ninefold in the January to March period, and for the full year, Office swung back to profitability Foreign companies setting up shop in India and a thriving startup ecosystem are fueling demand for companies like Office. And I'm delighted to say that Amit Ramani, Chairman and Managing Director at Office Space Solutions, joins us now to give us more insight into these numbers. Amit, great to have you on Inside India. So it's a solid story for the first quarter, and you swung to profitability in FY 2025. How sustainable is that picture for FY 26? And do you see any challenges to numbers like that and that pace of growth next year?
Yeah, so I think clearly, I think last quarter of FY24 we turned profitable, right? And we have continued to maintain that profitability all through the year, all along in all the quarters. If you look at the whole industry, I think it's done extremely well, from 16 million square feet in 2020 to almost touching 80 million square feet today. That's the flex market in India. So obviously the macro has done well. I think India has overall done well as an economy over the last few years. India is a completely under-commercialized market. And flex is solving a big problem, and hence has grown at 20 to 25% almost quarter on quarter. And so we feel that this journey will continue. And FY26, we don't see any challenges. As we gave our guidance yesterday, we look to grow at about 30% for FY26, and almost similar level of seat capacity we should be able to add. We added about roughly 39,000 seats in FY25, and we should be able to match that in FY26 as well.
Yes. Amit, for our viewers who may not be familiar with the ecosystem as it applies to India, Office is India's biggest flexible workspace solutions provider. Just give us a sense of the potential addressable market in India and why co-working spaces are in such demand.
So overall, India commercial market is about 860 million square feet today. Over the next few years, in the next 2 to 3 years, this would touch almost 1 billion square feet, right? As I mentioned, this year we did about 16 million of new stock was added in Flex, which is almost about 20% of the overall 80 million gross leasing that happened. Now, to give you a comparison, all 6 boroughs of New York City is about 450 million square feet, and all of India is about 860. So clearly, it's a very under-commercialized market. And clearly, finding space, quality space, is a challenge. The complexity of setting up infrastructure, a good infrastructure in India, is complicated. And hence, Flex is solving that need. Today, if you look at it, it is basically coming along because of the distributed work that happened post-COVID. Clearly, flexibility. You can take as many seats for as long as you want. And the ease of use, right? You can easily get it. In case of Office, the other piece that works really well is the network. Today, we have 210 centers that are operational across 18 cities in India. Almost 100 plus micro markets are mapped with us. So you can find an Office location in the top 7 tier cities, almost in a 10 to 15 minute driving radius. So hence, it's solving flexibility, it's solving distributed work, it's solving scalability, and it's solving accessibility.
And is the asset-light leasing model one that is working out for Office, Amit, at this point in time? Or would you consider shifting some parts of the business to an asset ownership structure? Does that work, and is that appropriate for some cities and markets within India?
So we are an asset-light business, right? And hence our return on capital employed is almost 62% for the year. For the quarter, it was 76%. And we believe that this model is probably the only sustainable model going forward. Almost 67% of our portfolio today is in what we call as managed aggregation, which is basically an asset-light model where a landlord partner is investing majority of the capital, and then we do a profit share with them. As we go forward, this ratio will continue. We will not get into any asset-heavy business. We are akin to an hospitality play, right? I mean, we are a day hotel. And from that perspective, I think it's proven in the hospitality space that this is the only model that works, right? This is the only model that's scalable. And hence, in the last 10-year journey, we have been able to get to about 200 plus locations in a very short span.
How would you rate the competitive challenge from WeWork, which is your biggest rival, Amit? And what are the USPs that give Office the edge?
So we clearly have a few differentiators. One is the network. We have the largest network by far in India when it comes to the number of centers, number of seats, number of cities. We also believe in a much smaller format. So typically our centers are about 30-odd thousand square feet, gives a much more community feel. You are able to have a more community approach to the whole thing. Very strong focus on our customer diversity. Today, we have 3,000 client companies that call us home. We service less than almost 45% of our portfolio is less than 100 seats, and rest is more than 100 seats. We service every type of customer. We have 3 flagship brands. We have the Office brand, which is about 85% of our portfolio today. We have Office Gold, which is an Office Elite, which is basically the remaining 15%. So we service every price point. So it's like a Toyota Corolla, Camry, and a Lexus in the market. And hence we are able to address size of the cohort from 1 seat to 1,000 seats. We are able to address somebody who needs a $100 seat and somebody who needs a $250 seat. So I think those are the main diversity, and clearly the customer experience. I think because of our strong hospitality focus, the customer experience that you get in our centers is at par with any global operator.
Amit, can you tell us where occupancy rates stand? I understand that they're close to 75%. And what expansion plans do you have in mind? And how many offices do you plan for the current and the next fiscal?
Sure. So current occupancy is roughly, as you said, it's about 73%. And I think stable state, which is more than 12-month-old centers, is about 84%, which we look at as our stable state occupancy. As I mentioned earlier, we would look to add about the similar number of seats that we added in FY25 for FY26. And this pace, we believe, will continue to help us keep our center at the similar level of occupancy. As an example, we sold in FY24 about 37,000 new seats. In FY25, we sold about 53,000. So obviously the pace of seat addition has kept up with new seat sales as well. And we look to continue to that momentum as we go forward.
And are Tier 2 and Tier 3 cities on the table in terms of expansion and next steps for Office?
So we are currently already in 8 Tier 2 cities. We will add Vijayawada this year to get to about 9. Tier 3, we don't believe is an opportunity, at least for the next few years. And I say that because of primarily compliant supply available in Tier 3 cities, right? So as long as we have compliance in terms of supply availability, we will expand into that city. And we believe the 9 cities that we are in today is where the future of India from 4 trillion to 10 trillion economy is going to be written in addition to the Tier 1 cities, but no plans for Tier 3 cities right now.
If the expectation, Amit, is for more multinationals to set up in India, and that's all to the good for Office Space Solutions, then are you basing that on the conclusion of some landmark trade deals between India and the United States, of course, and the European Union? UK-India is already in the bag. To what degree are these agreements going to be drivers of international capital and international investors into India? And how much of a virtuous circle do you think that's going to create for Office?
No, so clearly, yes, I think the trend is being seen even before these deals were announced, right? If you look at the global capability centers that over the last 20 years got to about 1,800, and the next 3 years are going to get to about 2,500 of these are going to be set up, from 50-seater to 5,000-seater centers. All of these plans have been announced. We have been very fortunate to be able to address a large part of that market. We have set up Elite, our premium product, exactly for that. We have companies such as Meltwater, ABC Fitness. We have Zinov, which is a large GCC consulting firm. They have set up shop in our centers. And we feel today that this demand, in addition to the outsourcing continuity, India offshoring, which is already a large part of our portfolio today, will continue to drive demand in India. And, we feel that overall the landscape for India is very, very strong because the macro factors are strong. Commercial activity in terms of provision of great supply is available, at least in tier 1 and tier 2 cities. And that will allow people to come to India to set up these large centers. And as they set up these centers, we are clearly one of the choices that they would have in the country.
I mean, if rents are soaring in the big urban centres in India, then how do you make the pricing environment appealing, competitive and affordable for your clients? There must be a fair degree of pressure to increase the rates that you charge.
So clearly that has been there. I think, rents have gone up. But even when you look at the overall landscape, they have gone up by about 20% overall, if you look at the overall macro numbers. And currently it stands at about 85 rupees per square foot, roughly, which is about $1, right? The reality is over the last 10 years, it has continued to remain in that dollar range, right? It's just that the currency is depreciated. So from a global standpoint, when they look at these markets, the rents are almost same, right, over the last 10 years. And, clearly the demographics gives the advantage because almost about, I would say, 70% of the cost is towards the manpower, right? And the rents essentially are between 10 to 15% of the overall economic. So I think from that standpoint, India continues to remain a choice for a lot of these large multinationals who are looking to get work done. And clearly towards even the GCCs today, where earlier it was about BPO and KPO, today complex tasks like research and AI are being done in the country. So I think the demographics have moved and the rents, I think, are continuing to remain in a very affordable range.
It's interesting you mentioned the AI build-out, which is arguably in a nascent stage. Is there a theme that Office can perhaps latch onto? And are there, I mean, we can talk about Bengaluru and that being a very well-established IT hub, but are there other potential Silicon Valleys in India that you see arising that represent opportunities for Office?
So I think clearly Bengaluru overshadows, everybody. But I think the reality is if you look at today the global capability centers that are being set up, a lot of them are happening out of Hyderabad. Pune is another big market where we see a lot of GCC traction happening. A lot of companies, global multinationals are also expanding and setting up their centers in these locations, including places like Navi Mumbai sees a lot of traction today. And for certain SaaS and product-based companies, Chennai becomes a great market, right? I think so. I think we see these top 4 or 5 markets continuing to grow. And obviously, Gurgaon and Noida are already established as those markets. So I think the top 6 markets, I believe, are all very, very capable for all of these different tasks to be done out of India and have the supply available today for them to be absorbed.
I mean, you've clearly got your hands full with the Indian market, and it's a huge potential addressable market for flexible co-working spaces and solutions. But do you have any plans at this stage for expansion internationally, either within the South Asian region or even beyond?
So I think I would just keep it simple. I mean, from our standpoint, we believe the opportunity in India is so large that, moving into any of the other markets is not on the cards currently. We are very clear that we have a market leadership position in India, and we want to continue to maintain that as we go forward. And from that standpoint, currently no plans to be outside India. Understood.
And if we can put up a chart of your stock's performance since the IPO in May last year, it's up by some 60%. What has this listing and the capital generation, the capital formation that it's enabled, what has it enabled you to do that you would not have been able to do otherwise if you didn't list?
So I think clearly, I think credibility goes up. I think the trust in the business goes up from a business standpoint, client standpoint. I think a lot of our teammates that had the stock got 1x to 50x of the yearly salary, which we are extremely proud of. As a business, we were extremely capital light, right? I mean, we raised about 130 odd crores towards primary capital into the company. I think so clearly, I think our trust went up, our ability to attract and retain better talent went up. We added a whole bunch of leadership team in the last 6 months. And it's obviously given an exit to our original shareholders, which were investors with us, and obviously a great outcome for our teammates. So I think all of this put together, I think net was a great move. And we were one of the first ones to successfully list in the co-working space globally. So extremely proud of that fact. We are almost at their 1-year anniversary today, and the stock has done well, and we are extremely proud of it.
Amit, we'll leave it there. Great insights into the co-working space in India. Thank you very much indeed for joining me on the programme. Amit Ramani there of Office Space Solutions. Now, before we head to a break, tracking IPO activity in the Indian market, stockbroking platform Grow reportedly filing draft papers for an IPO. Platform has filed the papers confidentially, according to Reuters. Grow is one of the most anticipated listings of the year in the Indian markets and could debut in the last quarter of this calendar year. A company that's backed by the likes of Tiger Global and Peak XV is aiming for a valuation of around $7 billion. Now, the Indian markets have joined the trading day. We'll look at the action after this short break. We're back in 2. Welcome back. Let's give you the Indian markets, which are now up and running. This is what the benchmark Nifty 50 is doing. Some give back, actually, and we're dropping below the 25,000 point threshold. Let's give you the dollar-rupee exchange rate, and we are seeing some weakness in the Indian rupee. 85.2820 against the US dollar, down by about 0.3% for the rupee against the dollar. Bond yields. Let's take a look at them. And this is where we stand for the benchmark 10-year bond yielding 6.2%. The Reserve Bank of India is set to transfer a record surplus to the Indian government. RBI's board approved FY25 surplus of over $31 billion, expected to give a bit more fiscal leeway to the Modi government. Let's give you shares of Gillette India after the P&G-owned company posted a 60% rise in quarterly profit, up by 2.25%, and a 12% jump in its revenue thanks to sales in their grooming category. An air carrier Indigo could see a further stake cut by its co-founder Rakesh Gangwal. CNBC TV18 is reporting Gangwal will sell up to a 3.4% stake in the airline through a block deal worth around $803 million. Gangwal has quit the board of Indigo and has been paring his stake over the last 2 years. Shares of the airline's parent company, Interglobe Aviation, performing weekly, down by 2.4%. Right, let's stay in the travel space. And many travellers use online reviews to help plan their trips. I know I do. But just how many of these are fake? CNBC's travel editor, Monica Petrelli, is here with more. And there are even things like review farms, like troll farms.
There's so much more to this issue than I had realized. And what we're seeing now is a report coming from TripAdvisor. This is obviously a big company, one of the very first to do reviews way back in the day. This report, it's called a transparency report, saying that about 2.7 million of reviews contributed back in 2024 are deemed to be fake. That's of about 31 million, about 8 to 9%. But the bigger issue here is this is about twice as many, it's more than twice, in fact, that the company detected in 2022. Now, does this mean we're just seeing a surge in fakes? Well, the company says not necessarily. They said they're taking a more aggressive stance against incentivized reviews. We've probably all faced this at one point. This is where a company says, hey, I'll give you a freebie or a discount if you'll post a review. And the company also saying our detection methodology is getting much, much better. Now, this is a three-pronged system that is used, first relying on auto detection, which the company says catches most fakes, then a human review process, following with a community dispute process, which pulls a lot smaller amount off. Now, there's different categories of fakes, as we just saw posted there. One of the biggest ones, not in terms of fakes, I will say it's a small category, but one that Becky Foley, who leads TripAdvisor's Trust and Safety team, says is a particularly pernicious. These are paid reviews. These are what you said earlier, these review farms. And we are seeing a lot of these coming out of Asia Pacific, led by Indonesia and Vietnam. Now, India here on this board, actually you can't see it, but it's at number 8, just at 3%. But this is a change from the 2022 report, which had India in the top spot as the top purveyor of these paid reviews.
And there's even a form of, call it a smear campaign, call it industrial espionage, and it's defined as vandalism under the TripAdvisor investigation. So how do we... So it's very multifaceted. So how do they determine what is a fake review? I suppose a lot of bot-like language may give it away.
Yes. So if you want to know how complicated this issue is, go look at the guidelines for TripAdvisor's reviews, and you'll see how, I imagine these guidelines probably started rather small and how lengthy it's become because of how creative people have become with their reviews. But how that they catch these fakes is really technology. And this technology, it's TripAdvisor's own tech, developed over 25 years, has a lot less to do with how these reviews are worded, much more with patterns that are detected in how they're posted. So, for example, one paid review, and TripAdvisor says it actually poses as paid review brokers. One paid review, somebody that bites on that, hundreds of data points are then released, which it can then use to not only determine it knows that paid review is fake, but it can then use it to find many, many others. So it's a technological cat and mouse game that is happening.
And there are repercussions for this, aren't there? They are almost taken down. Are they taken down?
They're taken down. Yes. Absolutely. If they're deemed to be fake, they're taken down. What happens is if a company is found to be behind this, the company, the exact opposite of what the company is trying to do, it wants to go higher in the rankings. The company, TripAdvisor, pushes it further down, and this lasts for a year. Now, if you are found to be a repeat offender, you get a red badge, and that red badge is effectively TripAdvisor telling its customers, hey, you can book with this company if you want to, but we have information that says that this company is trying to deceive you with the reviews. So, tread carefully.
But, this level of oversight and transparency is good, ultimately, for you and I, for the consumer. I've been lucky so far with the advice that I've taken from TripAdvisor and Airbnb as well, which arguably does quite a good job in terms of oversight. Excellent. Thank you very much indeed for that, Monica. Let's take a look at the Asian market, shall we, before we go? And they are giving us a mixed picture. We are seeing some areas of weakness, some areas of strength, but overall non-committal at this stage. That's all we have time for today on this edition of Inside India. Do keep watching CNBC. Dan Murphy is up next with Access Middle East.